When it comes to your IRAs and 401ks, this is where many of you may hold the majority of your wealth. But let me ask you, when is the last time you updated your paperwork on these accounts? Today, I want to walk you through a couple examples to help you avoid some significant pitfalls when it comes to your IRA and 401k paperwork. Keep it right here. Hey everyone, Chris Earlite here, CEO of Reap Financial and host of Wealth Radio every Saturday at 11 a.m. on News Radio KLBJ, host of Retire Ready TV every Wednesday, 6 p.m. News Hour on KXAN here in Austin. Thanks for making us part of your day. If you like our channel, hit the subscribe button down below. Okay, so many people don't take their IRA and 401k paperwork seriously enough, and this can lead to terrible consequences. Here are two case studies that may surprise and shock a lot of people. The first case study involves an IRA owner who failed to notify the custodian that they moved recently. They changed addresses, but they didn't let the IRA custodian know of their new address. Most people know that they can change IRA custodians anytime you want, but what few people know is that IRA custodians can actually decide to stop being the custodian of your account. Under conditions specified in the IRA documents that most people don't read, a custodian can actually close an IRA without any action by you, the IRA owner. Now, the most common provision says the IRA custodian can resign and close the account 30 days after notifying you, the owner. That gives the IRA owner, you, time to roll over the IRA to a new custodian. Now, typically, if the custodian doesn't hear from the IRA owner within 30 days after the notice is sent, the account's closed. A custodian closes an IRA by distributing the account balance, usually in the form of a check, and mailing it to you with a letter of explanation to the last known address. Now, the custodian will also send a Form 1099-R to both the IRS and you, listing the account balance as a distribution. Now, you, the IRA owner, will have to include that amount in your gross income for the year, unless you're able to roll it over to a qualified retirement account, another IRA, within 60 days of the distribution. Now, here's where it gets interesting. In a recent case, the IRA owner moved, and the custodian didn't receive notice of the new address. After some time passed, the custodian sent a letter to the owner at the last address on file. Now, that letter said that the custodian was resigning from the account, probably because a lack of activity in the IRA and a lack of contact by the owner. Now, the letter, a subsequent distribution of the IRA, and 1099-R were all sent to the last known address, but it wasn't forwarded to the IRA owner. Eventually, the IRS sent the taxpayer a letter to their current address assessing additional taxes, because they said that they failed to include that IRA distribution in the gross income. Now, after consulting with their CPA and doing a lot of paperwork, the IRA owner was actually able to get a hold of the money and roll over the shares of stock it held into an IRA that was a qualified account. Now, the CPA then drafted a request that the IRS waive the 60-day requirement and accept the rollover as a tax-free transaction. What do you think happened? Believe it or not, the IRS ruled in the IRA owner's favor, so no additional taxes or penalties were due. Now, to avoid the taxes, the taxpayer had to undertake a lot of paperwork, pay his CPA a lot of billable hours, and incurred a $10,000 fee from the IRS. That's what they charged to request a ruling. Now, the IRA owner incurred these costs because simply they did not notify the current custodian of their new address. There was no additional communication because the IRA custodian did not know where to send the check, where to send the letter, and communications from the IRA custodian somewhat vanished. So many of you may have moved over the years. You may have moved to, new addresses, maybe moved out of state. This simple paperwork snafu can cause significant consequences, okay? Now, the second case involved is over a dispute of the inheritance of a 401k between the deceased account owners and a second spouse and his children from the first marriage. Now, earlier in his career, this deceased owner had worked for many years at a firm that had a nice 401k plan and had designated this account for his children as joint beneficiaries of the account. Now, this firm was acquired by another firm from whom the owner was working at the time of his death. Now, the assets from the 401k of the original employer were rolled over into accounts of the new employer 401k plan. Now, the owner apparently failed to file a new beneficiary designation form when the new employer merged. Now, under the rules of a new 401k plan, if a plan member fails to name a beneficiary, the surviving spouse, if any, would take or would be the sole beneficiary of the account. Now, the plan administrator sees a widow as a sole beneficiary in this case. Now, remember, this was a second marriage. This was a second spouse. Now, when this person died, the 401k owner passed away. Because there was no beneficiary designated, it was distributed to the second spouse. Now, what do you think the children did? They filed a claim for the account with the administrator, and the administrator denied the children's claim and asked the court to decide who the beneficiary was. And the court ruled that the widow was the sole beneficiary. Now, the children argued that when the previous employer was acquired, that all the plan terms and documents merged into the new plan, and they also said that, that included their beneficiary designation. But there was no evidence of this. There was no evidence that the two firms intended to merge the plans. And the new employer's plan was a separate plan. And a new beneficiary designation form needed to be filed, and it wasn't. And the deceased owner's previous actions and the terms of the will indicated that he intended for his children to inherit most or all of his assets. But none of that matters when a retirement plan is concerned. All that matters is a beneficiary designation form. And since there was no beneficiary designation form filed with the new plan, the rules established by the plan prevailed. Now, this can happen with 401ks. This could also happen with life insurance. When is the last time you updated your life insurance beneficiaries? Now, think about it. If you were divorced, if you remarried, you may want that death benefit to go to your children, some friends or family members. But again, unless it is designated on a beneficiary designation form, in most cases, it doesn't matter what's stated in your will. Beneficiary designation form typically will always prevail. So these are just two simple examples of how you can fall into some pitfalls when it comes to these IRAs, these 401ks, accounts that you potentially have a lot of wealth in. So you can clearly see why your retirement account paperwork must be done correctly. And we can do an analysis for you of all your retirement accounts and give you a very comprehensive retirement analysis at no cost. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team of fiduciary advisors will look forward to sitting down with you and your family. Until then, all the best.